Welcome to It Depends, a sales tax podcast by TaxConnex. I'm your host, Brian Greer. Sales and use tax can be confusing and very overwhelming, but it doesn't have to be. Whether you work in industry or at a CPA firm, or just someone who wants to stay informed about the latest sales tax laws, we've got you covered. Periodically, we'll explore different aspects of sales tax. So whether you're a tax pro or a novice, tune in and join us as we attempt to simplify the complexity of the sales tax world. This is It Depends, because with sales tax, there's rarely just one answer, and often that's our answer to many questions. It just depends.
Welcome back to It Depends, the podcast where the answer to any sales tax question is rarely straightforward, and today's no exception. I'm Jeff Meigs, and on this episode, we're diving into a topic that all of us are hearing about in boardrooms, warehouses, and government halls alike, tariffs, and how they may or may not impact your sales tax processes. So what are tariffs? Tariffs are basically excise taxes or fees that countries impose on goods imported from other countries. It's intended to try to make fair trade practices across multiple government agencies. And one aspect of the tariff is protecting domestic companies in the U.S. against unfair, unregulated trade practices of foreign entities competing for the same business. So from an accounting perspective, tariffs are essentially a cost of goods sold. Though they've recently been the top of news headlines, tariffs are nothing new, but the recent tariff volatility has created a challenging business landscape for many, in some cases resulting in companies adding tariff surcharges to invoices. So that's the topic of today, is how are tariffs treated for sales and use tax purposes? And while this protocol usually starts with the term "it depends," in the case of tariffs, there really isn't any gray area. When it comes to the applicability of sales and use tax, tariffs essentially become a part of the taxable base of any product or service sold. There's a very limited statutory or administrative authority published by the states addressing tariffs specifically. Instead, the states tend to address the taxability of tariffs as a part of the taxable base of products and services. And in most cases, the states will define the taxable base as inclusive of all costs incurred and associated with making the product available for sale. This would include costs such as design, engineering, inbound freight, raw materials, fabrication, and for the purposes of this discussion, tariffs, or any excise tax fee that's incurred directly by the seller prior to or in association with the sale of a product. An example of how the states have addressed this might be found in Washington. Washington states that surcharges added to invoices to cover expenses, including tariffs, are included in the selling price and subject to tax. When the sale is considered a retail sale, the seller must also collect retail sales tax on the total selling price. This is the case even if the tariff is listed separately on the invoice. For example, a clothing store imports sweaters from Canada and is charged a tariff. The imported sweaters sell for $60 each, and the store adds a $5 tariff surcharge to the bill when the customers purchase them. The entire $65 of gross income is subject to the retail sales tax. When a customer that imports a product and is responsible for paying the tariff to the customs authority, the tariff paid by the customer is not subject to sales and use tax. Washington State, for example, says the following: surcharges added to invoices to cover expenses, including tariffs, are included in the selling price and subject to sales tax. When the sale is considered a retail sale, the seller must also collect retail sales tax on the total selling price. This is the case even if the tariff is listed separately on the invoice. For example, a clothing store might import sweaters from Canada and be imposed a tariff. The imported sweaters usually sell for $60 each, and the store decides to add a $5 tariff surcharge to the bill when customers purchase them. The entire $65 of gross income is subject to retail sales tax. When a consumer that imports a product is responsible for paying the tariff to the customs authority directly, the tariff paid by the consumer is not subject to sales or use tax. In this case, the consumer is responsible for the applicable use tax on the product purchase price, which does not include the tariff that the consumer paid. The difference being that the customs approach to the applicability of the tariff was imposed directly on the customer, separate and apart from the sales transaction. Generally, all states will follow this sort of guidance as it was related to Washington, and the Streamlined Sales Tax Governing Board has given similar direction. The rule of thumb is that tariffs are part of the taxable base of product services when paid by the importer and either incorporated in the price of the product or where the tariff is separately stated by the importer on their invoice to the customer for taxable products. So how are businesses handling this? For many, it's a challenge of compliance meets customer service. We've got products that are increasing in price, but our cost basis is increasing accordingly. Some companies choose to bake the tariff into the total price, which makes invoicing simpler, but can raise sticker shock. Others show it as a separate fee, but then must still calculate sales tax accordingly. So what should you do if your business is dealing with tariffs? We've already talked about how tariffs are taxed. They're part of the sales price and are subject to sales tax, regardless of whether or not you separately state them on the invoice. They are an excise tax and essentially are built into the cost of goods sold. It can be important to check your state's specific guidance, and while we believe many states take the same position as Washington, it is possible that a state might introduce some temporary legislation that might account for the volatility in tariffs. So tariffs are just one example of how otherwise direct taxes can sneak into your pricing model and your compliance obligations. As policies shift and prices fluctuate, keeping up with the tax rules is critical to avoiding surprises. And while many sales tax questions come down to the phrase, it depends, this one is a little more clear cut. Tariffs are taxable, plan for it, price for it, and be ready to explain it to the customer. That's it for this episode of It Depends. Thanks for tuning in. If you're curious about other confusing corners of the sales tax world, be sure to subscribe. We'll keep breaking it down one complication at a time.
This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. See you next time.